Podcast is now starting. All attendees are in listen-only mode.
Good morning, everyone, and thank you for joining us for today's webinar, Net Returns on Rented and Owned Land. My name is Julia Froik. I am the project coordinator here at the Partnership for Ag Resource Management and will be hosting the webinar this morning. We are joined today by Ashley Brucker, Ohio Agriculture Stewardship Manager for American Farmland Trust, who will provide a brief introduction on AFT. I'm also pleased to welcome our guest speaker, Michael Langemeier, Professor of Agricultural Economics at Purdue University. Before we begin, I will go over some brief logistics. Please make use of the question box on your screen to type questions for Michael during his presentation. I will moderate the questions during the last 10 to 15 minutes of the webinar after the presentation. We suggest viewing this webinar while connected via Ethernet for best audio quality performance. You'll receive an email in the next few days with the webinar recording link. The recording will also be available on partnershipfarm.org and YouTube. Please take our webinar evaluation. The data collected from this evaluation is critically important to evaluating the success of the Great Lakes Conservation Connect webinar series. The webinar evaluation will be emailed to you within the next few days. A link to the evaluation will also appear in a box at the end of the webinar. By attending today's webinar, you are eligible for 1.5 CCA continuing education units, 1 for professional development, and 0.5 for crop management. You must be present for the entire webinar to receive those points. If you submitted your CCA number at registration and are watching the webinar live, no further action is required to submit your CEUs. If you are watching this on demand at a later date, please be sure to watch the entire presentation through the GoToWebinar platform and not YouTube to receive credit. If you watch the webinar recording more than 2 weeks after the original broadcast, please email julia@partnershipfarm.org your CCA number to ensure your credits are submitted. Please note that credits often take a few weeks to appear in your account. If it has been more than 4 weeks, please contact my email. And now, with the logistics taken care of, I will provide a quick introduction to the Great Lakes Conservation Connect project. Great Lakes Conservation Connect is a collaborative partnership of conservation agencies focused on engaging both women, non-operator landowners, and farmer tenants to work together to increase conservation practices on their land. Why women? Because we have a successful model to engage them, and research shows they are interested. We'll hear more about that in a minute. Really, we're starting with women, but much of what we're learning applies to all non-farming landowners. A key component to our goal is increased communication between the farmer and landowner to enable leasing structures that make it easier for farmers to try new practices. In order for farmers and landowners to see the benefits of implemented conservation practices and continue to invest, it is necessary to extend leases beyond 1 year. According to the USDA's Economic Research Service, more than 54% of U.S. cropland is currently rented. Many landowners can be removed from agriculture, unaware of the risks of depleting soil health and practices that exacerbate runoff. We need to provide outreach to both landowners and tenants now more than ever as the percentage of rented lands continues to rise. Great Lakes Conservation Connect is working towards our goal of increased beneficial practices on rented lands by providing resources for developing lease agreements, like this webinar, communication and education strategies, and working one-on-one with farmers and landowners in Ohio and New York through learning circles and workshops. Our goal is to scale up the project to other states within the Great Lakes Basin. The Partnership for Ag Resource Management, or PARM, a project of the IPM Institute, is working to engage retailers in providing resources to their clientele to help integrate beneficial practices on rented lands. Helping customers access resources to start conversations with their landowners means selling additional products and services like cover crops, variable rate technology, or subsurface fertilizer application on increased acres. With extended lease terms, you can secure your clientele for a longer period. We have created a brochure for ag retailers as a handout for their customers. Order several now and pass them out at your next grower meeting. Contact Julia at partnershipfarm.org to get yours today. Lastly, to access additional information, visit the Farmland Information Center. And now I'd like to turn it over to Ashley Brucker, Ohio Agriculture Stewardship Manager at American Farmland Trust, who will provide a brief introduction on AFT's role in Great Lakes Conservation Connect.
Thanks, Julia. So very briefly, if you haven't heard of American Farmland Trust, we are a national nonprofit organization. We were founded in 1980 with the mission to protect farmland. Currently, we have about 70 staff distributed between our headquarters in DC and our 6 regional offices across the country. We maintain a holistic vision of farmland protection that is essentially 3-pronged. So first is a focus on protecting the land itself from threats such as urban sprawl and keeping it as farm or ranch land. Second, we focus on the management and maintaining healthy land by promoting sound farming practices. And third is a focus of keeping farmers on that land and providing a pipeline to move young farmers onto farmland. Next slide. As Julia mentioned, the goal for the Great Lakes Conservation Connect project is to get more conservation on the ground. Specifically, we are working towards more conservation on those rented acres, and we're working with multiple partners to accomplish this. AFT's role in the partnership is to lead the project and coordinate all of those partners. There is a focus on 3 particular audiences who we've identified who could be influencers moving forward. Those are women landowners, farmers, and retailers. I'm going to address what we are doing with women landowners, as that is a unique model. Our conservation learning circles are based on a model that was initially designed, tested, and refined by the Women Food and Ag Network about 10 years ago. It is peer-to-peer learning that acknowledges these women as integral parts in the decision-making process for their land. Participants in the learning circles are primarily women who are non-operating landowners, but we do have some women who are actively farming. So we start by bringing everyone together to discuss specific conservation topics. We adhere to the idea that we all have something to learn and we all have something to teach. So there is no hierarchy or lectures from the front of the room. Even the conservation staff who are attending blend in and participate in the conversation. So if you look at the picture on the slide, you wouldn't be able to pick out the conservation staff if you wanted to, and that's exactly the way we want it. So the first part of the day, we do work to keep the meeting women only, not because we're trying to be exclusive to women, rather the idea is to design a space that is focused on making women comfortable talking and asking questions about agricultural issues, soil health, water quality, and so on. That's also driven by the feedback from the women themselves. They have stated that they really appreciate this open atmosphere we've created in the learning circles and feel comfortable asking their quote unquote stupid questions. And I can tell you their questions are always a far cry from stupid. They're always very insightful and thought-provoking. So learning circles are typically full-day events with the discussion in the morning, and then in the afternoon, we try to arrange a farm visit to see practices on the ground and have discussions with farmers and conservation staff. At this point, we do include any men who are the local resource professionals or the farmer hosting us. Part of the lesson is knowing the people and the resources available in their community who can help them manage their land. AFT has facilitated over 50 learning circles across the Midwest, which is offering us the opportunity to speak with hundreds of women landowners about conservation and land stewardship. We repeatedly hear many of the same concerns, leading us to the same impressions. Women are very interested in learning more about their land. They're just not sure how to go about doing that. And they're interested in the technical information and the details behind agriculture. In talking with these women, we've learned that we never have to dumb anything down. We just need to be aware that we don't overuse jargon. They really trust their farmers and consider them to be the expert in farming. They often speak very highly of their farmer as a resource for information. And just to clarify here, a non-operating landowner is not the same as an absentee landowner. So many of these women, non-operating landowners, are still living on or very near the farm they are renting out and are still involved in the local communities. So maintaining that family and community harmony is very important to them. They really want to talk with their farmer more, but also want to be respectful of a farmer's time and not be considered a burden to them. We do often hear the phrase, all the chemicals and questions surrounding chemicals. These usually don't come from a desire to not use any chemicals or a push to go all organic, but rather just to understand the role and the purpose of the chemicals in the system, in the management system. Leasing is also a popular discussion topic, and the prospect that you can change a lease to benefit both the landowner and the farmer is really interesting to them. And lastly, legacy attached to the land and really a love for that land always comes through in all of our discussions. So they're really concerned with succession planning, what they're leaving behind, and what they can pass on. And all of this is really great for the farmer. For anyone looking to make changes to their management systems or to make improvements that they may need their landowner to pitch in on, this shows that often the landowner is open to having those discussions. And finally, we are collecting survey data from non-operating landowners, both male and female, across 11 US states, and that information is confirming what we are hearing in the learning circles. The bottom line is landowners do trust their farmers, and they are interested in soil and water quality, and they are comfortable addressing at least changes that may accommodate more conservation. We still see a lot of verbal lease agreements out there, with the majority being on an annual term. However, at least in the Midwest, the average amount of time a landowner works with the same farmer is longer term, typically 15 to 17 years. So those annual leases are being renewed year after year for about 16 years. And that's all I have. Thank you, Julia.
All right, thank you, Ashley. Now, before we begin the presentation, I have a few brief PARM announcements. Our regular PARM webinar series will continue on July 16th with a webinar on recarbonizing row crop farms. There will be another PARM webinar in early August on crop scouting for pests and diseases, exact date to be determined. The Great Lakes Conservation Connect webinar series continues in early September, topic and date to be determined. Please note that we take into consideration your suggestions for webinar topics, so be sure to fill out our evaluation form after the webinar. We also invite you to follow us on Facebook and Twitter for PARM updates and industry news. Now we'll get the presentation started with Michael Langemeier, a professor of agricultural economics and director of cropping systems for the Center for Commercial Agriculture in the Department of Agricultural Economics at Purdue University.
Good morning. Glad to be with you this morning.
All right, your slides look good, Michael. Go ahead.
This morning I'd like to talk about several different topics. We'll start out with some basics related to leases, and then we'll gradually get into more detail. At the end, I want to talk a little bit more about what drives cash rents, changes in cash rent terms over time. And so to do that, we need to look at the relationship between cash rent and net return to land. And then finally, I want to talk a little bit about why land is such an attractive investment, not only to people that farm, but also to non-operator landlords and also institutional investors. And so what makes land so special that people want to invest in it and many times hold on to that land for many years. And so to start with communication, this is always the place I start when I talk about leases. I want to talk about oral versus written communication. Oral communication between the landlord and the tenant or the operator is extremely important. Landlords that just inherited land should not be shy to ask the operator or tenant questions about what their current practices are, what the crop rotations are, what their plans are for the future in terms of crops. If they have questions related to fertilizer or chemical, ask those questions. Most tenants and operators love to talk about their farming operation, and so they're not going to not like it if you don't ask questions. It shows that you're interested in making sure that this is a long-term relationship between the landlord and the tenant. And so I recommend that the landlord gets several updates throughout the year, or the operator provides several updates throughout the year in addition to questions. Maybe hand delivering rent check if the landlord is local, and talking to them about the crop year. How often you communicate really depends on the agreement. We're going to be talking about types of leases here in a few minutes. If you have a crop share lease or what I call a flexible cash lease, which I'll define here in a few slides, you're probably going to communicate more frequently than if you have a cash rent lease. But regardless, it's important for there to be communication between the operator and the landlord, particularly if it's a relatively new operator or relatively new landlord in this relationship. Written communication is critical when you're talking about lease agreements. Written contract is a must. A lot of people rely on the oral agreement, but a written contract really does a nice job of laying out some of the things that the landlord wants to happen, and also some of the expectations regarding the operator. And so I encourage written leases. In most states, if the lease is longer than 1 year, the lease has to be in writing. I've already discussed this a little bit on the previous slide, but let's review here. How frequently should you communicate? Here's from the operator perspective. It does depend on the landowner. If it's a new landowner, it needs to be more frequently, at least 2 to 3 times per year. Some operators and professional farm managers in particular provide monthly reports during the growing season related to how the crop is doing. That's not a bad idea for the operator to provide a monthly report, just updating the landowner on how the crops are progressing, how things look, regardless of the type of lease. Certainly you don't want to leave issues unaddressed. And so, for example, if the landlord is really worried about the fact that the operator is not using cover crops, let's just use this as an example, talk about that. Explain to the operator why you think cover crops would be a good idea, and the operator will talk about it from his perspective. Maybe the reason they're not using cover crops is it's a short-term lease, and so they're not comfortable using cover crops, something that's more of a longer-term benefit on a short-term lease. So you can work that out. Maybe the reason they're not using cover crops is it costs too much, and so maybe you can work out some kind of cost-sharing arrangement related to cover crops. And so frequent communication is very important. That leads us to something that I strongly recommend, that the operator produce an end-of-year report for the landowner. And this end-of-year report can include various things, but I think some of the things on this slide are very important to include. What crops were planted? What were the yields by crop or field? Again, this is regardless of the type of lease. On a cash rent lease, you're going to receive a fixed payment, and so you're not going to share if there's higher yield. But it's important for the landowner to know what was the yield on that particular field or land that I own. Is there any production notes? What were some problems that occurred on the land in the last year? Is there land issues or some things that need to be addressed? Maybe the landlord needs to make some improvements, and those things need to be addressed in this end-of-year report. What are the plans for next year, specifically related to crops that might be grown? If it's a crop share agreement, then there needs to be detailed summary of the shares and how the shares were calculated. This would be detailed information on seed, fertilizer, and chemicals used typically. If it's a flex lease or a flexible cash lease, there needs to be detailed components of the rent formula or how the rent was computed. Because with these leases, there's typically a fixed bonus, and then there's a fixed rate, and then there's a chance for a bonus. And so everybody needs to know how that bonus is calculated, particularly in years where there isn't a bonus. And so let's just review. Working with a new operator, working with a new landowner, what are some things that need to be communicated? So if an operator is working with a new landowner, we need to build this relationship. It's like any other relationship in agriculture, but this one's really, really important, because from the landowner's perspective, this might be his primary source of income. From the operator's perspective, one of the most important things that a farmer or an operator makes is leasing and purchasing of land decisions. Land represents over 80% of the value on average on a farm balance sheet. This is using U.S. Farm balance sheet information from USDA ERS, and so it's an extremely important resource both to the landowner and to the operator, and so that's why needs to be this communication. If it's a new landowner, ask questions about the history of the land. Ask about prior lease arrangements. You can even ask them why they're choosing a different operator, for example. Ask about expectations and check in frequently. And so this would be a new operator working with a new landowner. If you're a landowner working with a new operator, there's a similar set of issues here, but slightly different perhaps. We're building a relationship again. As was mentioned earlier, even though we have annual leases are very common in production agriculture, many times these lease arrangements have existed for a long period of time. It's not uncommon at all to see situations where they had the same operator-landowner relationship 15 years, 20 years, even more. And so we want to build this relationship and get off the ground right away in a positive way. Ask questions about tenants' production practices. State expectations, and don't be afraid to ask questions. Don't be afraid to ask questions is important for both the landowner and the operator. Now let's review some leasing principles. As I indicated before, one of the most important decisions made by farmers and ranches is leasing and purchasing land. An asset base that is too small makes it difficult for a business to efficiently utilize their labor, particularly family labor, and other inputs such as machinery and equipment. And so many times, many operators are looking to expand. And so a landowner may have several opportunities or several different people that want to rent their land. This is why, because an asset base that's too small really creates some inefficiencies with respect to labor and capital, particularly machinery and equipment capital. On the other hand, an asset base that is too large often requires borrowing a large amount of money, which may cause serious cash flow problems, financial stress, and inefficiency. And so this decision is extremely important for operators to make. Leasing versus ownership, this is from the operator's perspective. Leasing assets provides a means for acquiring the use of assets without the cost of purchasing assets. For example, where I'm at here in Indiana, our average lease rate would be about $250 per acre. The land value is $9,000. And so obviously, if I lease that ground and spending $250 per acre, where if I'm buying that ground, it's $9,000 per acre, which is spread over time, don't get me wrong, but usually there's a pretty hefty down payment that's required. And so in many cases, when farmers are looking to expand, particularly if they're bringing a younger family member into the operation, they're really taking a close look at leasing and also opportunities to maybe purchase land close to them. But this is a very difficult decision for farms as they're thinking about expanding. When we compare the cost of leasing to ownership, this is not the topic of this webinar, but just to give you some idea of what's involved, we need to look at the cost of capital. How much money can we, what is the interest rate that we have on borrowed money? What is our capital worth? If you're a farm, your capital can be used for many different things, to purchase grain bins, to purchase tractors, to purchase combines, purchase planters, and so they're thinking about, should I go ahead and use my capital to purchase land, to rent additional land, or should I use my capital for something else? And so it's the value of their capital in addition to the interest rate on borrowed money is extremely important considerations. Right now we have relatively low interest rates, and that's very helpful in terms of being able to buy land. Also, land increases in value over time. In fact, if you look at, again, U.S. data from the USDA ERS, over half of the return to land over a long period of time comes from the increase in the value of the asset over time. And so when you're buying land, you don't just look at the cash rent, you also look at the potential increase of the land over time. And so I usually, when I'm talking to people about investing in land, I use the analogy of stocks. Many times when you're buying a stock, it has a dividend, which is an annual payment, plus it has any increases in value over the time. The same is true for land. We have the cash rent, which is a cash rent, share rent, or flexible cash rent, which is our dividend, but we also have this capital gain or increase in the value of the asset over time. And as I indicated, over half the return to land over time is this increase in the value of the asset over time. So that's extremely important to understand as both an operator of land, but also a landowner of land and an institutional investor in land. All of those folks need to clearly understand what are the sources of returns for land. Also, the cost of maintaining an asset is also a consideration when we're looking at leasing versus purchasing of land. Basically, now let's talk about some basic lease information. There's a website called Ag Leasing 101 that I do not have on this slide, but I'm getting some of this information directly from some publications on that website. So Ag Leasing 101 is the website. A farm lease should contain at least the following: legal description of land, term of the lease. Here I'm talking about whether it's an annual lease, a 2-year lease, 3-year lease, amount of rent to be paid, and time and place of payment. It's very typical to have two payments per year. Names of owner and tenant, signature of all parties. Obviously, I'm talking about a written lease here. Dates and procedures for notification of lease renewal and cancellation. Those are usually dictated by state law, particularly the cancellation. And then this last one is really important. Some leases will not have very much related to this last point, but you're thinking about conservation aspects, cover crops, some of these issues. This last point, very important. Provisions spelling out rights and responsibilities of each party, or what are the expectations of the operator, what are the expectations of the landowner. This would include who pays for long-term improvements on the land. For example, if a line typically lasts several years, who pays for that? Typically, when you have something that lasts several years and you have a very short-term lease, you think that the landowner is going to pay that. But that isn't the case in all leases. Sometimes the lime is paid for by the operator, and there's adjustment made to the rent, adjustment downward made to the rent to account for the fact that lime was purchased. And so this is the section where you spell out some of those rights and responsibilities or expectations of each party, including some of this cost share information. This slide is extremely important when you're talking about land leases and you're talking about efficiency and equity. And so this is kind of your fair leasing slide, if you will. The objective of any land lease should be to provide a fair and equitable return to both parties for the inputs they contribute to the total farm operation. And so with a cash lease, the landowner is providing the land, sometimes long-term improvements on the land, and that's it. The operator is paying for all the other costs associated with growing corn, soybeans, wheat, or whatever crops are raised on that ground. And so that's what I mean by the return to both parties should match the inputs. And so for example, let me just talk through an example here. In Indiana, over a long period of time, about 1/3 of the total cost of producing corn and soybeans is associated with land. And so you'd think over time that the landowner should receive about 1/3 of the income, because that's to represent their share of cost in this arrangement. And so that's what I mean here by fair and equitable return to both parties matches the inputs they contribute to the total farm operation. Most people would agree that a fair and equitable sharing arrangement exists when both parties are paid for the use of their inputs according to the contribution of those inputs make toward generating income. And so let's get a little more detailed here. Let's say that we have a crop share lease, and in addition to providing the landowner also pays a share of the seed and fertilizer and chemicals. In that case, they should get more than 1/3 of the income long term. In Indiana, the percentage would be closer to 50%. And so in a situation where they're providing the land plus a share of the seed, fertilizer, and chemicals, they would receive about 50% of the income, because the inputs that they're providing are about 50% of the total cost. And so that's the idea behind an equitable lease. Let's talk a little bit more about term of the lease. This is a component of the lease. So let's talk about improvements. This can be a sticky issue, and it's very important to talk about when we're talking about lease principles. Many times, landlords may be reluctant to invest in buildings or other improvements, particularly long-term improvements, when using annual leases. Conversely, some landlords may expect to receive rent for buildings for which the tenant has no use. And so it goes both ways. And so for longer-term leases, the advantage of longer-term leases, it encourages the investment in improvements. And so if the ground needs tile, even if this cost is shared between the operator and the landowner, which it typically is, the landowner needs two things. The landowner needs an adjustment in the rental rate to reflect the fact that he's putting money into tile. Also, the landlord wants the operator needs a longer lease to make sure he's taking advantage of the fact that he's spending this money on tile. And so longer leases are extremely important when you're looking at investments in things like tile drainage and irrigation. Across the Corn Belt over the last several years, we've seen a large increase in tiling, and that's worked out quite well in situations where we have longer-term leases, and they can come to an agreement on how the cost is shared, but also how the terms of the leases are changed to reflect the fact that we have we've invested in tile drainage. Also, it makes it easier to agree on the use of specific conservation practices, such as cover crops would be one example if we have a longer-term lease. The operator is much more likely to invest in things like that if there's a longer-term lease. They know they're going to be able to keep the ground for a longer period of time. Also, longer-term leases also encourage the operator to pay closer attention to the levels of potassium and potash on the ground. Sometimes with short leases, the operator has less incentive to keep the phosphorus and potassium levels as high as they would otherwise. And so longer-term leases have many advantages. I've just pointed out a few of them in this slide. And I'm assuming some of the questions will be related to term of the lease. And so I wanted to make sure I at least covered that briefly. So now let's look at types of leases. And I don't want to go into a lot of detail here, but we need to talk a little bit about the different types of leases. All of these are used in the Corn Belt and the Plains and elsewhere in the United States. And so they all have their place. Let's start with one of the most common ones, is the cash rent or the cash lease. In this case, the tenant or operator pays all costs except land ownership costs. And so they pay a fixed amount in order to farm that ground. The landowner pays all land ownership costs. If there is things like lime or cover crops, those need to be discussed with the operator. And if there is some kind of sharing arrangement there, if you're having a longer term cost like that, the rent needs to be adjusted to reflect the fact the operator's paying part of those long-term improvement costs. The operator receives crop government payments and crop insurance indemnity payments. This year there's going to be quite a bit of preventive planting across the Corn Belt, and so that would be an example of a crop insurance indemnity payment. The landowner receives a fixed rental amount. Now this is fixed for the term of the lease, and so it's an annual lease. That rental amount, at least conceptually, can change every year. Whether it changes every year depends on the business climate, and I'll talk more about that later in the presentation. The operator or tenant takes on all price and yield risk in this case. This is the reason why it's attractive to some landowners. They don't want to incur this price and yield risk. They don't want to take the chance that corn price is going to decline and they're going to have a lower rent check because of that. They don't want to take the chance that yield's going to be lower than was expected, and you're going to have a lower cash rent a rental payment because of that. And so that's why these cash leases are quite attractive to landowners in many cases. Crop share leases are still common. They're not quite as common as they used to be, but they're still common throughout the center part of the United States. So let's talk a little bit about these. Here the tenant and landowner share some variable costs. Now the key word there is some. Not all variable costs, but some. This does vary depending on where you're at in the Corn Belt. This crop share lease arrangement in Indiana would look quite different than what it would look like in western Nebraska, where my in-laws are from. It would be a different percent in terms of what is shared. It would also be different variable costs that are shared between the western Nebraska and the Indiana. So these do vary, geographically, depending on how productive the soil is, basically. So the tenant or operator pays remaining portion of variable costs, provides labor, and of course covers machinery ownership costs. The landowner pays all land ownership costs. Landowner receives a share of the revenue as rent. In this case, price and yield risk are shared. I'll give you an example for where I'm at here in Indiana. If we have a crop share lease in this part of the world, we're probably looking at a 50-50 lease, and so the operator gets 50% of the revenue and the landowner gets 50% of the revenue. In that case, the landowner pays for all land ownership costs. They're providing the land for the operator to farm. In addition, the landowner pays for 50% of the seed, fertilizer, and chemicals. As you move further west, particularly western Kansas, western Nebraska, that 50% drops to 1/3, and the types of costs that are shared are different. So these are dependent on the local situation. The flexible cash lease is relatively new. Here, the operator pays all costs except land ownership costs, and so in that case, it's similar to the fixed cash lease. We'll get to why it's different. Landowner pays all land ownership costs. The rent amount varies based on price, yield, or gross revenue. So essentially, in a lot of these flexible cash leases, there's a fixed amount or kind of a minimum rent. That minimum rent, for example, could be 90% of the market cash rent. And so that's the fixed amount, regardless of what the price or yield or the gross revenue is for a particular crop or crops planted on the acreage that the landowner owns. They're guaranteed a base amount. That's typically called the base amount. Common base amount is 90%. In the Eastern Corn Belt. However, if the price and the yield or both go up rather substantially and the gross revenue is higher than what we thought it was going to be, the landowners paid a bonus. And so years like 2010, 2011, even 2012, landowners received a bonus that was above and beyond this base amount. In recent years, where the gross revenue has been lower in production agriculture, the bonus has been closer to zero. And so that's the idea of the flexible cash lease. It combines aspects of the cash lease and the share lease. So I'm going to go through a case farm example. There's more information for this example on the Center for Commercial Agriculture website, and so I'm going to go through this rather quickly. But I did want to talk a little bit about the fact that these leases are fairly typical, other than on what the landowner receives each year. in the crop share and the flexible cash lease situation, the income is more variable. If that's the case, why would anybody ever want the crop share and flexible cash lease? The crop share and flexible cash lease, when we have really high gross revenue in agriculture, like we did for much of the 2007 to 2013 period, in those periods, the landowners paid more money than they would have received with the fixed cash lease. And so that's why they're attractive to some landowners. And so the Case Farm here is going to plant 50% corn, 50% soybeans, and located in west central Indiana. And so the crop share lease is similar to what I discussed earlier. Landlord pays 50% of seed, fertilizer, chemical, and crop insurance costs and receives 50% of all revenue. We have a fixed cash lease, and then we have a flexible cash lease. This one's set up with a base rent set at 90% of fixed cash lease, and then the landowner receives as a bonus 50% of corn and soybean revenue above non-land cost plus base rent. The non-land cost typically is derived using budgets. Each land-grant university usually has budgets for the key crops in their state, and so you can use the non-land cost from a budget, and then if the revenue is above non-land cost plus base rent, then they receive a bonus. And so let's take a look at this, looking at 1996 to 2018. And so let's give a couple examples of the flexible cash lease before we get into the details. In 2010, the cash rent in west central Indiana was $184 per acre. It's increased, it's higher than that now. So the base rent is 90% or $166. Non-land cost and base rent was $576. We had a revenue of $772. That was a good corn price year, corn and soybean price year. So we had a fairly high revenue. That's an average revenue between corn and soybeans. And so in this case, there actually was a bonus, and the bonus was close to $100. And so that was a really good year for the landowner with a flexible cash lease. Contrast that with a flexible cash lease in 2018, where the base rent now was $221 because we had higher rent than we had in 2010. In this case, the non-land cost of base rent is higher because cost of production was higher in 2018 compared to 2010. And so in this case, just by coincidence, the revenue was exactly the same as non-land cost and base rent, so there was no bonus. We had very strong yields in 2018 in west central Indiana, but the price was not real high compared to what it was in 2010 in particular. And so even though the revenue was relatively high because of the good yield, we still did not get a bonus in 2018. So that's how the flexible cash lease worked in a couple years. And so just real quickly, let's contrast the fixed cash and the crop share. You can see here that the blue line is below the red bar in quite a few years. Those are years in which the cash lease paid more than the crop share lease. However, from 2007 to 2013, the crop share lease hit a home run. The return per acre was considerably higher for the crop share lease than it was for the fixed cash lease, showing you that when revenue is really good, the crop share lease is a really good lease for the landowner to have, to partake in. And so it clearly shows that. But it also shows the fact that the crop share lease is considerably more risky. And so it's certainly not for everyone. The flexible cash lease combines the fixed aspects of the fixed cash lease with the crop share lease, and so it's kind of in between. It also did quite well during that 2007 to 2012 period because there was bonuses, and I'll show you the bonuses on an upcoming slide here. But also notice in the previous chart, in recent years, the crop share net return was quite low. The flexible cash lease is below the red bar, indicating that the flexible cash lease is lower than the fixed cash lease because there hasn't been a bonus, but you're limited to being 10% below the fixed cash lease, whereas with a crop share lease, there's no limit. That could be $50, $75, $100 below the fixed cash lease if the revenue was really low in a particular year. And so the flexible cash lease is not as risky as the crop share lease. Now, all of these leases over this period of time generated very similar net return per acre for the landowner. And so which of these leases the landowner wants really depends on how much risk they're willing to take. If they're very risk averse and really don't want very much risk, the fixed cash lease is quite attractive. If they want to receive high incomes in times where the revenue, the crop revenue is relatively high, then looking at the crop share or the flexible cash lease is prudent. This is just looking at the differences between the two. Just showing you they take flexible minus fixed. There's only a brief period there, essentially 2007 to 2012, where the flexible was better than the fixed. The same with the crop share. It also shows you in recent years how much better the flexible cash lease was compared to the crop share lease. The crop share lease was extremely problematic in 2015. We had a very wet June in 2015 in west central Indiana, and so the crop yields are relatively low. These were the years where we actually got a bonus. It was more than the 2007 to 2013 period. There was also some bonuses from 1996 to 2002. They weren't near as big, but there was bonuses in those years too. So these are the bonuses with the flexible cash lease. Now let's talk a little bit about the relationship between cash rent and net return to land. And what I want to do here is talk about the main driver of cash rents or rental rates. So I just want to review that before we talk about land investment. And so there's several key factors impacting cash rents. One of them is simply lag cash rent. Cash rent adjusts slowly to changes in net return to land. I'll show that on the next slide. It shows you a chart of this. Net return to land can be quite volatile, and cash rent adjusts slowly to changes in net return to land. And so, for instance, from 1996 to 2006, net return to land was relatively flat, and so cash rent was relatively flat. As we got into 2007, the start of the ethanol boom, net return to land increased rather dramatically. Cash rent slowly but surely increased. And then once we got to 2014, which was the peak of cash rents in Indiana, it actually peaked in 2013 east of here, but that was the peak for Indiana. As net return to land declined from 2014 on, cash rent slowly adjusted downward. And so cash rents are sticky, if you will. They adjust to changes in net return to land, but they adjust slowly. The other big factor, of course, is lag net return to land. And so as the net return to land changes over time, particularly as we enter into very good times for net return to land, cash rent is driven up. As net return to land declines, like it has since 2014, the cash rent tends to decline. And that's, of course, based on crop prices, crop yields, government payments, production costs are all important when we're looking at net return to land. I also should put in there crop insurance indemnity payments are extremely important when we're looking at net return to land, particularly in 2019. And so this is the chart I was promising you. I'll look at this from 2007 to 2018 in the next chart, but I wanted to look at this on a longer-term basis first, and it just shows you what I was talking about in the previous slide. Net return to land is considerably more variable than cash rent, and this actually makes a lot of sense. Think about how hard it would be to negotiate very large changes in cash rent from one year to the next. The operator doesn't know if the net return to land is going to stay high. The landowner, the same token, he doesn't know whether this is going to be a 1 year cash rent and then it's going to decline sharply. And so rather than adjusting completely to net return to land, cash rent adjusts slowly to changing conditions. Now, if we look at this chart in west central Indiana, it peaked in 2014, the cash rent, and declined about 15% going into 2018. It actually increased slightly in 2018 because we had very strong yields in 2018. This is looking at it on a shorter period of time since the beginning of the ethanol boom, and so it shows a little clearly, the the difference between net return to land. And so we saw the buildup in net return to land all the way to 2013, the peak in 2014, and then the decline as the net return to land dropped down to that $150 to $200 per acre from 2014 through 2018. Now, just to talk a little bit about some outlook for cash rent here, net return to land in 2019, there's still a lot of uncertainty because of all the prevented planted acres across the Corn Belt, and that also creates uncertainty with respect to prices and yields. But given some huge shock to the system, we're expecting the 2000 net return to land to be similar to maybe slightly lower than the 2018 net return to land. If that's the case, then cash rent to land will be relatively stable. If for some reason the net return to land is quite a bit lower than what it was in 2018, then we would have some pressure for the cash rent to decline. And that pressure of the cash rent to decline is also going to be important when we talk about land values. So let's talk about land investment. I'm going to talk about this in a very general way. If you have more specific questions, by all means, when we get to the question and answer section, you can ask those questions. And so let's review some factors impacting land values. And so just like cash rent, lagged land values are very important, meaning that land values adjust slowly to changes in cash rents. And so cash rents adjust slowly to changes in net return to land. Similarly, land values adjust slowly to changes in cash rents. And so it takes some pretty large changes in cash rents and actually some trends. Are cash rents trending up or cash rents trending down for land values to move? And so that's certainly an important consideration. Also, cash rent is also important, obviously, driven by lagged cash rent and lagged net return to land. So net return to land impacts cash rent, which subsequently impacts land values. And so net return to land does impact land values just indirectly through cash rent. Interest rates are also an important factor. When we're looking at land values, a higher interest rate, for example, results in a decline in land values. We've had very low interest rates over the last several years. And actually, the recent Fed policy changes suggest that interest rates are going to stay relatively low, at least for a while. That's had very, very positive impact on land values. That's kept land values up higher than what they would have been otherwise. And so if you look at these factors right here, if you're looking at the 2014 to 2018, 2019 period, the cash rent net return to land has been lower. That's caused land values to drop. The interest rates have been, they were slightly higher a year ago, but they're still relatively low. And so the interest rates have been somewhat neutral looking at land values. If down the road interest rates were to increase, 2, 3, 4 years down the road, that would have a negative impact on land values. And so let's look at these together. This is West Central Indiana cash rent and farmland price. I'm just using West Central Indiana to illustrate these concepts. This would be very similar regardless of where you were at. Particularly if you're in a situation where urban influence is not as important as it is not that important, which in terms of West Central Indiana, it's not that it's unimportant, it's just not as important as it would be in areas closer to Indianapolis, for example. And so here, land values and cash rent is primarily driven by what's going on in production agriculture or net return to land. And so we see the big increase from 2007 to 2014 in both. And then we see the drop from 2014 to 2018. Let's take a look at the scales, both on the left axis and the right axis, because it's real easy just to cover this real quickly and say, yeah, cash rents and land values increased. We knew that. But let's look at the scale of the change. If you look at 2006, for example, and you look at land values, we were talking land values of about $3,500. In 2014, land values were over $9,000. And so an extremely large increase from 2006 to 2014, less than 10 years. What drove that increase? Low interest rates, which are not shown on this chart, and the very large increases in cash rent or net return to land, which I showed on previous charts. But cash rent during the same period went from less than $150 per acre all the way up to $285, $290 per acre. And so cash rents also increased rather dramatically, starting in that 2006, 2007 period. And for those of you that may not be as familiar with what was going on in production agriculture since 2007, that was really the start of what I'm calling the ethanol boom. Corn and soybean prices increased dramatically, and they have not reached the levels that they were at prior to 2007, even when they were relatively low in the last couple years. And so we're kind of in a different era in terms of prices, and so we're in a different era in terms of cash rent and farmland values. And so you can see farmland and cash rent values have adjusted. They've both dropped about 15% in west central Indiana. Some places in the Corn Belt and the Plains, land values have declined closer to 20 to 25%. But the point is, even though they've dropped, they're still substantially higher than what they were prior to 2007. So that's extremely important to understand that point. And that's true, pretty much for land all across the Corn Belt. Now, if you look at U.S. land prices, again, using USDA NASS or USDA ERS information, land prices really didn't adjust near as much at the U.S. level as they did at the Indiana, Illinois, Iowa, Nebraska, Minnesota, Kansas, South and North Dakota, Wisconsin, Michigan levels, at the state levels. And the reason for that is when you get to the two coasts, there hasn't been as much pressure for land values to decline. And so when you're looking at the U.S. average, the adjustment, it hasn't been near as big as what it has been in corn and soybean country and wheat country. So I want to take a look at the farmland price to cash rent ratio. This is one way to look at relative price of land and see if it's getting out of hand or much higher than we would typically think it to be relative to cash rent. And so when you talk about stocks, they talk a lot about the PE ratio, which is the price to earnings ratio. And if that ratio is relatively high, then it's maybe not as good a time to buy the stock as if the ratio is relatively low. And so here I've got farmland price to cash rent, analogous to the PE ratio. And the farmland price to cash rent multiple is very high. It approached 35 here, looking at the actual price to rent ratio in recent years, whereas the long-term average is closer to 20. Why is it relatively high right now? Well, the big reason is the low interest rates. And so we're going to see a relatively high farmland price to cash rent multiple, if you will, as long as we have relatively low interest rates. If interest rates would increase dramatically, which I'm not expecting them to, but if interest rates would increase dramatically, you would see larger adjustments in land than you would in cash rent. And so, in other words, we'd probably see weakness in farmland price, and we may or may not see weakness in cash rent. One of the things I didn't talk as much about as I sometimes do is from 2006 to 2014, even though cash rent and land values both went up, land values went up faster than cash rent, and that was due to the low interest rates. And so anybody that's a landowner or thinking about investment in land, this is a very important chart to think about. What do we expect interest rates to do? What do we expect this multiple to do over time? This is repeating something I talked about earlier, the fact that a very large proportion of the rate of return on land comes from changes in values. Here, rather than using an annual change, I've used 10-year moving averages, and you can still see that both of them are important contributors to return on investment. The left-hand side, those are actually percentages, and so the 0.05 is 5%. And so you can see the rent has been fairly stable. In 1970, it started over 5%, and in recent years, it's been closer to 3.5%. But nevertheless, it's been between 3.5% and 7% over a long period of time. So it's been very, very stable over time, whereas the change in value, in some years, it's well over 10%. We can see that in the late 1970s. We can also see that during that 2010, 2011, 2012 period, it busts through 10%, but there's also times where it's negative, as it was in the mid-1980s. It got down to below negative 5% for 2 or 3 years in the late 1980s from a 10-year moving average standpoint. So this shows two things. It shows that both of them are important sources of land earnings, but it shows that the change in value is quite volatile. The reason why this is important is land is not something you're going to hold on a very short-term basis. You may buy a stock or a bond and maybe you'll sell that in a year or 18 months. Land's not like that. Land's an asset that you typically hold for a long period of time, because if you buy at the wrong time, you could be facing a very small or negative change in value, and your rate of return on the land is going to be very low. So land is more of a long-term asset, if you will, in terms of investing than a lot of other assets. It's probably more analogous to commercial buildings or commercial real estate, houses. So now I want to review some literature with a graduate student I'm working with, and look at how farmland fits into a portfolio that consists of stocks, bonds, gold, and real estate investment trusts. So looking at the commercial and housing, commercial buildings and housing. And so what are the optimal weights of farmland investment relative to other assets in a portfolio? And I'm not going to go through exact percentages here, but we looked at several different portfolio strategies. Mean variance is a very common strategy where you're interested in both higher returns, but you're also worried about volatility or variability. And so variability is a negative, means a positive, and then you look at see how the different investments respond from a mean variance framework. We also looked at minimum variance, equal risk contribution, where all the assets had the same risk contribution and equal weighted portfolio. What were our conclusions? Farmland was found to be a very good diversifier of risk in a traditional portfolio. We didn't do this research to encourage people to invest in farmland necessarily. Rather, we did this research to explain why so many different people are interested in investing in farmland, and it's because it works really, really well, or fits really, really well with some of these other typical asset types. However, of course, farmland is not something that you're going to invest in 1 year and sell the next, and so it's a long-term investment. And so when you look at putting farmland into a portfolio, you're typically talking about pension companies. Pension companies that are going to hold onto the land for many, many years and keep that land in their portfolio. That's the type of institutional investor you typically see buying farmland, in addition to farmers and other non-operator landowners. It's also a good reason if you're inheriting farmland or you're going to pass farmland on to your heirs, that you clearly talk to them about the fact that farmland it fits very well into a traditional portfolio and has pretty solid returns over a long period of time. And encourage them to hold on to this asset because it does have some very positive aspects in terms of risk and return. Farmland was a dominant weight in mean variance, minimum variance, equal risk contribution portfolio strategies, and so that's just to say it was extremely important part of these portfolios. Farmland also has some unique aspects in that it's probably one of the best hedges against inflation out there. We typically talk about hedges against inflation. We talk about gold or farmland. Farmland's even better than gold. And again, I don't expect inflation to run rapid anytime soon, but farmland is a really good hedge against inflation in case inflation does increase. Farmland holds its value quite well. I would like to conclude by just talking a little bit about the Ag Economy Barometer, something that we've been doing here at Purdue. This is a monthly survey of 400 U.S. agriculture producers focused on the major crop and livestock enterprises listed below. Heavy focus on corn, soybeans, wheat, and beef producers. And so let's look at some of these results with respect to land. Before I do that, some more characteristics of the survey. all the respondents to the survey have a gross income greater than $500,000. We do not survey the same producers each month, but the characteristics of the survey are held constant from month to month. So this is the basic Ag Economy Barometer Index that combines 5 different questions. As it indicates, a monthly index. The index in May was relatively low. In fact, this is the lowest index we've seen since October 2016. Why is the May index so low? Well, we had tremendous planting problems across the Corn Belt. That certainly reduced sentiment, made sentiment more pessimistic. But also prices in mid-May had not increased as much as they have in the last month, and so prices were a little bit lower in mid-May. It did not look like the prospects for net returns looked very good looking into the fall, and so that reduced sentiment. And also, the survey took place before the announcement of the market facilitation program payments, and so there was just a lot of negative things going on in that mid-May period to draw down sentiment. We're going to be releasing the new index on July 2nd that shows the results for the June survey. A couple questions that we ask frequently are questions related to land. And so compared to today, what are your expectations for farmland prices in your area 12 months from now? This has been the last few months. There's been a higher percent that think that land prices are going to show some weakness in the next year compared to those that think we're actually going to have higher land prices. And actually, we're looking at West Central Indiana, for example. We're looking at stable to probably a little bit lower. And so I would be in that about the same to lower category myself. I'm hard-pressed to think where we're actually going to have higher land prices, and that's because we have so many acres that didn't get planted to corn and soybeans, and producers had to take preventive planting in this region of the country. Looking long-term, on a scale of 1 to 9, this is from a farmer perspective. I already told you institutional investors look at farmland positively. From a farmer's perspective, what do they think about the demand for farmland in the area? Still a lot of interest in farmland. Farmland's typically rated as a good investment, and there's very strong demand for farmland in their area. And so if you're a landlord, this is really good. Even though net return is down, there's still a lot of interest in leasing and purchasing farmland. And one of the main reasons for that, I don't want to belabor this too much, but you still have a lot of people that have brought somebody back to the farm, or just in general that want to grow. Anytime you have a situation like that, that creates demand for farmland, because even though outside investors or institutional investors and other people that are not in production agriculture purchase farmland, in most parts of the country, the largest purchaser of farmland is farmers themselves. And so what their thoughts are in terms of farmland being an investment and demand for farmland is extremely important in terms of driving cash rents and driving land values. Thinking long term, what are your expectations for farmland prices 5 years from now? Higher, lower, about the same. And so this is quite different than the next 12 months. People are expecting farmland prices to be higher 5 years from now. We didn't ask them specifically how much higher. I would think that 5 to 10% higher farmland prices would be rather optimistic from my standpoint. But nevertheless, we are seeing some stability to farmland prices after seeing that 15 to 20% drop that we saw from 2014 to 2018. My last slide before we address any questions, here's the website. You can find more information about those lease comparisons, more information about the Ag Economy Barometer and leasing in general.
Okay, great. Thank you so much for sharing, Michael. We do have time for Q&A, and we'll be accepting questions from the audience. So we are going to give attendees 1 minute to submit your questions. Please enter your questions into the question box on your screen. We will be back on to answer questions in 1 minute. Okay, 30 more seconds to send questions in. Okay, so to get started with the Q&A, the first question we're going to do is, how does a landowner determine a fair per acre rent amount when renewing a lease?
Well, one of the things they need to do is, sometimes it's hard to find information on this. They need to try to see if there's any survey information available out there. Many land grant universities do an annual survey of land values. That'll at least get them a starting point. Now, hopefully the survey that they get from the university also has the cash rent tied to productivity, either to soil productivity or, in our case, corn yield. That's one of the reasons why in the end of the year report, even if you have a cash rent lease, it's very important to get a report on what the productivity was in that previous year, because that gives you a signal on how productive your soil is. So when you start digging around for cash rent information, you can figure out whether your cash rents are relatively high or relatively low. And so that gives you a starting point. Also, I think there is information out there on net returns to land, either from USDA ERS or again from land grant universities. So you kind of get some idea of what's been happening in terms of profitability and production agriculture. And so with those two things, you should be able to come up at least with a ballpark range for the cash rent.
Okay. And as a reminder to the audience, feel free to keep sending questions in as we go along. And the next question we're going to do is, do you believe Indiana farmer situations and land prices are fairly equal to Ohio's agronomic industry? And has there been any discussion on hemp?
Let's go a little wider than Ohio. Let's compare Illinois, Indiana, and Ohio. Illinois land values have declined more than Indiana and Ohio. Indiana land values have declined more than Ohio land values. When you get really right down to it, why that's the case, I'm hard pressed to understand why the decline in land values from 14 to 18 was lower than Ohio. One of the things that has occurred in Ohio, talking to some people from Ohio, is your property taxes are still relatively high. We did get some relief from property taxes in recent years in Indiana, and so that's certainly one contributing factor. But nevertheless, Ohio land values did drop less than they did in Indiana and Illinois.
Okay, next question is the current ASF crisis in Asia seen as having a long-term effect on grain prices and therefore net returns to land in the future?
That's a very difficult question to answer, but I think short term the impact won't be that large, but long term it could be, and that could impact us in two different ways. One is along with the trade dispute with China, that's also impacting us in regard to this. But one of the things that we could do in response to that is we could ship more pork to China. Well, if we ship more pork, that's going to increase the production of pork in this country, which increases demand for corn, which would have a positive impact on corn. And so that's certainly it's a potential to have a positive impact long term. I don't think the impact is going to be near as large as the impact of the trade dispute.
Okay, and I forgot the second part of that last question, and that's has there been any discussion on hemp?
Yes, there's a lot of discussion on hemp, but I'm a very risk averse person, so I should qualify my comments, by starting with that. But I really think it'd be a good idea for producers to really see how the markets evolve for both the CBD and also the rope type product, because until we get a better idea of what the potential market is, it's somewhat risky to grow the crop.
Okay, next question is, in Indiana, have you experienced a trend toward energy producers becoming tenants, such as solar or wind farms, and how are those arrangements in terms of landowner economics compared to more traditional crop tenant arrangements?
I think there's going to be locations in Indiana and elsewhere where there's going to be a positive impact on land prices associated with these energy contracts. We saw that with the windmills in Indiana and elsewhere, where that had a positive impact on land values, and so certainly we're going to see some increases in land values in areas where that becomes really important. How big that impact that's going to be, or how widespread, that's a little bit yet to be determined. But I think landowners should always be looking for opportunities like this. You need to go into this with open eyes and get some legal advice in terms of the contract that's being offered related to these projects. But it's something they should take a look at if it's coming to their area, and see whether there'd be an opportunity to either to sell their land or lease their land over for a long period of time and increase their revenue.
Okay, next question is, some growers share profits with landowners even though it is not in their lease agreement. Is this a good idea?
Yes, I've ran across several instances where operators will pay bonuses if it's a particularly good year. If you're worried about keeping your landowner for whatever reason, it's not a terrible idea. You got to be a little careful you don't get too carried away with that, and you don't cause a situation where they expect it every year. And so communication is extremely important. Let's give an example. 2018, we had some farms that had extremely high yields. There's nothing wrong with sharing some of that high yield with the landowner, even though it's not in a lease arrangement. But if you do that, make sure they understand this is why we did it this year. Rather than having 180 bushel corn, we had 210 bushel corn, and so we want to share some of the really high yield with you to make sure that we keep this relationship with you, because you're very important to our business. And so no, it's not necessarily a bad idea. Just make sure it's communicated.
Okay, next question is, what are some things a grower can do to get a longer multi-year term on rented ground?
Well, the first thing to do is to open the conversation with the landowner, and you particularly open the conversation if there's some long-term improvements are really needed. There's a couple different things you can argue here. One of them, you could contend that I'm going to do a better job managing the lime, the phosphorus, and the potassium if I have a longer-term lease, because those particular fertilizer types last several years. And so if you give me a little longer-term lease, that's going to be very beneficial to my business, and will make sure that those levels do not drop below minimum levels. I mean, we'll monitor that much more closely if we have a longer-term lease. And so that's one example. That example's been out there for a long period of time. But I think cover crops is also an example of that. If the operator really wants to use cover crops, but it's just simply too expensive, approach the landowner and say, well, can you help share the cost of this cover crop, explain what the benefits are, and say, well, if we do this, could we have a little longer term lease, because it's going to improve the ground, and so it's beneficial for us to, rather than have a 1-year lease, to have a 3 or 5 year lease. And so just communicating and explaining why a longer term lease might be beneficial to both parties.
Next question is, how would you suggest a small or medium farmer compete with a large grower trying to grab all the land he can? I can barely show a profit with what I pay in cash rent now. Large growers are always knocking on the landowner's door, offering more.
This is one of the reasons why the communication is so important. They're going to get other people knocking on their door, and you want to make darn sure that you communicate them frequently in terms of that you're the best operator for that land. You're doing a really good job from a conservation standpoint, and making sure they're up to date with what's going on in that land at all times. Because you're building trust with that landowner, and if you build a lot of trust, they're not going to switch operators very easily. Yeah, you hear situations where some landowner $10 to $20 higher cash rent, and they're jumping to the next operator, but that's not the norm. And so keeping a really good relationship helps immensely. Another thing, if you're a small and medium-sized farm and you've got a younger member coming back to the farm, use that. Now, sometimes larger farms use that too, but saying, I've got a young son or a daughter coming back to the farm, and we're interested in not only holding onto this ground, but farming some other ground that you rent to somebody else. Is there possibilities for us renting that ground? And so it's very important to constantly be communicating and making the case that you're the best steward of that land.
Next question is, asking a landowner to make some drainage improvements will likely cause a raise in rent to recover the costs over time. Do you have a good suggestion on how to approach the landowner and avoid an increase?
There's a couple different things we can do here. There's probably more than two, but there's two things we can do here at a minimum. One is, and maybe this is a non-starter with some landowners, is see if you can get the landowner to cover the expense. Something like that is going to really benefit the landowner, and so just you're not going to know until you ask. Whether just be ready to say this is what it's going to cost. This is you can spread that cost over this amount of time. Here's the tax benefits associated with tiling, so he knows what's involved in him paying for the tiling expense. Now, if that's a non-starter, ask if you can share the expense. Again, having your ducks in a row in terms of what this is going to cost per acre, both upfront costs and also costs over time, and saying, okay, if we split the cost, this would be both of our shares, and by splitting the cost, maybe it's possible that we don't have real large increases in rent. That would be the idea behind splitting the cost, is we're going to keep the cash rent, relatively stable, or maybe even down a little bit, because I, as the operator, am paying part of the costs. And so that would be the thought behind that.
Okay. In the interest of time, I'd like to wrap up the Q&A. I want to thank you again, Michael, for joining us today. We really appreciate you taking the time to share your work.
You're welcome. I enjoyed it.
And now I'd like to acknowledge our funders and collaborators that made this webinar possible. In particular, the Great Lakes Protection Fund, American Farmland Trust, and the McKnight Foundation. I'd also like to thank PARM's Premier Egg Retailer members, the Andersons, a gold member, and silver members Gertie Egg and Nutrien Egg Solutions. Their contributions also helped make this webinar possible and help promote the strides that egg retailers are making to reduce nutrient impairments. For more information on membership, contact our manager, Caitlin at partnershipfarm.org. The PARM team also provides free resources for egg retailer employees, grower clients, and consultants, available on our website, partnershipfarm.org. On the left is our continually updated and 4R approved agronomist handbook, available free for download. The handbook includes algal bloom updates, trends in customer product and service adoption, and fact sheets that you can provide to grower customers to increase awareness of products and services that reduce nutrient runoff. Our phosphorus loss reduction wallet cards are on the right, which can be ordered for free on our website as well. These are a great conversation starter with your customers and can also serve as handouts in meetings. To date, we have distributed more than 25,000. As we wrap up, Please remember to look for the follow-up email in a few days with a webinar evaluation and webinar recording. If you submitted your CCA number at registration and are viewing this webinar live or the recording within 2 weeks of the original date, your CEUs will be automatically submitted. Only if you are watching the recording more than 2 weeks after the original broadcast date do you need to email julia@partnershipfarm.org your CCA number to ensure your CEUs are submitted. One last reminder to please take the webinar evaluation. The link to the survey is provided on this slide and will be emailed out to you in a few days. Also, a box will appear at the end of the webinar with the link. I want to thank you all again for joining us today, and I hope you join us again for our next webinar in July.